My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. The people make friends, just trying to make some money. My job is not just to entertain, but to educate and teach you, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. Everybody's worried about either a brutal recession or rampant inflation. Even on a good day like this, with the Dow gained 70 points, S&P climbed 0.36%, and NASDAQ advanced 0.35%. You even hear people fretting about stagflation, the prospect of a half-dead economy with prices that just keep going higher. But any market that's so at odds about inflationary growth versus a recession might very well end up in a halcyon-like middle, a no-growth, low-inflation scenario with no recession. Just plain old stagnation before re-acceleration with less inflation. Now, there's a ton of confusion out there. Long-term interest rates have been going down pretty consistently for the last few weeks, including this morning when we saw more downward pressure on commodities. But then as the price of oil continues to fall, now down roughly $25 from its peak, bonds reversed and rates started going higher. So which move is right? When the market can't make up its mind on an issue like the inflationary growth versus recession question, I find that often the answer falls somewhere in between. Now, there's really a great debate going on right now, which is, why did rates fall so hard to begin with? Was it the benign decline in the price of commodities, something that means the Fed might not have to raise interest rates as aggressively, or was it a malignant recession that's causing a decline in demand and earnings are about to fall apart? And optimist says it's the first one. The Fed tamped down on inflation and speculation via tough talk and 3 increasing severe rate hikes. So we're in for a soft landing, and we might get a bull market in cheap, profitable companies, especially stocks that benefit from lower commodity prices, which is what we're getting. But a pessimist, of which I'd say is the majority, a pessimist looks at the same data points and says, we're going to have a deep recession. This pain is just beginning. So it's clearly not too late to sell. That's what I hear most of the time. Why is it not too late to sell? Because earnings are going to evaporate and stocks are going to get hit pretty hard. So why the heck is it so hard to figure out which camp is right? Well, because there's genuine confusion. First, because we probably are somewhere in between. And we have to see some signs that the Fed has beaten not commodity inflation, but wage inflation. Got to do them both before we can confidently say that the pain is over. Until then, we could go either way. Second, is the Fed meeting minutes from the June meeting that were released today illustrate. We know they're committed to raising rates, but they didn't say we'll do one big hike and wait, which is what you do if you believe that there needs to be certainty about less inflation. Remember, inflation this bad must be killed, not just wounded, so I understand how they feel. Third, I think we're all being thrown off by the concept of who over-earned at the height of the pandemic. Initially, we figured it was only a handful of companies, right? Peloton, DocuSign, Zoom, Roku, you know the list. But one by one, we discovered many other post-COVID pariahs. The video game stocks suffered tremendously, even as their businesses haven't really slowed. They just returned to normalcy. The streaming stocks have been smashed. Netflix is the worst performer of the year. Disney, much to my charitable trust chagrin, has been crushed because the company can't shake off the fact that it, too, must be hurting because of Disney Plus, even though that's just one piece of the pie. We've only recently decided that there was over-earning all over the place. It's principally, I'd say, underneath pretty much all of the declines that I've seen, the serious ones, is the over-earning. For instance, the stocks of NVIDIA and AMD, they have been crushed because they make lots of gaming-related chips, and Wall Street now thinks gaming's in decline, so therefore those companies must be hurting. Those same chips are used for cryptocurrency mining. That's another nasty area. HP and Intel have seen their stocks plummet because their bottom lines were boosted by a COVID-era home office build-out. Now that's over. HP and Intel will have a very hard time bouncing back. Same goes for Best Buy, Williams, Sonoma, and Wayfair, although the first two are excellent companies with very cheap stocks, but they need rate cuts, and those are on the horizon that I can see. Now we still have one more derivative, the Internet itself. Several research firms have pointed out this week that Internet use is actually down this year, something almost no one thought could happen. That hurts all the companies that have benefited from the internet's growth, including the warehouse plays that enable e-commerce. It hurts the Fastleys, the Cloudflares. It hurts the Akamais, all involved with making the internet work better. It lays to waste so many online apparel companies, Stitch Fix, Postmark. And it even damages the case for the trade desks. And then finally, yes, the Googles and Facebooks. The whole online advertising edifice. It also explains the colossal underperformance of Amazon. When I say over-earning, I mean they made a lot of money thanks to the pandemic, and now that things are basically back to normal, that makes it seem like they're experiencing a slowdown. Really, it's just a reversion to the mean, but don't tell people that. They just think it's getting bad, and they want to sell. They don't even know what a reversion to the mean means. It's a tough concept. It just means it's going back. Commodity decline could be because we're headed into a recession, but it might also mean that we're speculators who bought up all sorts of commodities to take advantage of the expected shortages caused by Russia's invasion of Ukraine. The trade fell apart when the shortages failed to materialize, especially in oil, but also in food, by the way, at least for many parts of the, let's say, of the wealthier world. When Russia simply found a way to offload its sanctioned crude to India and China, well, that was it. Price of oil did come down. By the way, if you want to see a chart of food, look at this chart of John Deere. It's really incredible. Notice I'm attributing none of these declines to what everyone attributes every decline to, which is the Fed. At the end of the day, the Fed couldn't predict what a post-pandemic world would look like any better than the rest of us. And they certainly couldn't predict the complications caused by the war in Ukraine. You throw in China's unexpected lockdowns, okay, with the resulting supply chain issues, and it's very hard to make any kind of forecast. Given those cross currents, it's incredibly difficult to figure out whether we're about to go into recession or a soft landing, because the Fed may have already won its war against commodity inflation. It is definitely winning its war against housing and even rental inflation, and it may soon win the war against wage inflation. More on that later. Boy, the stakes are high. The banks are due to report soon. If the recession camp is in charge, the market will go down on every report of loan loss ticks upward, which will be regarded as the more important than even the higher net interest margins the financials are getting thanks to the Fed. However, I think that won't happen. Instead, we'll be impressed with the money the banks are making off their deposits. Remember, the depositors don't get much more than you get now, but think how much the banks are making. Again, there could be a third way, though. There wasn't enough stock and bond market activity for the trading businesses, so the stocks could go lower just on that thesis. Then the consumer packaged goods companies report they've been able to raise prices while their raw costs, often based on oil and gas inputs, have started falling. Meanwhile, their dividends look more compelling with lower bond prices. That could be an amazing moment for the consumer packaged goods plays, unless people say, well, the dollar's so strong, we don't want them. Tech goes up next, and I think there will be a severe bifurcation in this group. The ones that are profitable with stocks that sell well below historic multiples, think Micron, should rally. But the unprofitable companies that are sell on sales, I think their stocks fall once again. And it's not too late on this one little bounce to get out of what I regard as being the Cathie Wood stocks. Why am I more sanguine than just about everyone else, though, about the market? Because I think I'm more cognizant, having been out at this game for 40 years, that the damage already been meted out is severe. I don't like to hate a market that has come down this far. Here's the bottom line. At these levels, many stocks already reflect a recession. So if we merely get a stagnant economy that will then reaccelerate, then stocks could go much higher. But if the Fed disagrees with me and hits us with more than just one last big rate hike, but says, here's one and many more coming, I will have to recalibrate, and the market will have even more downside. I think I'm going to be right, though. Let's go to Jerry in my home state of New Jersey. Jerry!
Hi, Jim. Thanks for having me on the show and everything, and congratulations on your move to New York.
I'm very excited. The set is gorgeous. It's going to be a rebirth. Look, I've been doing it here for 17 years, and it is really time for a change. And I'm very grateful to the network for giving that to me. How can I help?
Good. So I have a question about Darling Ingredients. Looking over the stock for the past year, this thing has been highly volatile and everything. Do you see anything where this thing might kind of straighten up and maybe bottom out?
This is a company that, I'll tell you the truth. I'd rather see you own Clean Harbors. Darling Ingredients does recycling. I like the concept. The stock is down too much, and I'm going to embrace that. People should know this is a company that actually just traps the stuff that is like leftover refuse from restaurants. It's good. It's just not great. Let's go to Jeff in Oregon. Jeff.
Hi, Jim. It's Jeff. I'm calling from Oregon, and I want to give a shout-out to Retail Investment Tower. But my question is about GameStop. They're set to launch an NFT marketplace at the end of the month. Do you think this is enough to keep investors interested?
Okay, GameStop is what I call controlled stock. It's controlled by a group of investors. They announced a 4-for-1 stock split. We know that doesn't create any value, but the investors who control it move it up. There are really only two controlled stocks in our market, which is AMC and GameStop. What I say are controlled is exactly what I mean. There's no need to explain. Now, I am a lot more sanguine than just about everyone else that you hear about this market. Many stocks, to me, already seem to be reflecting a recession. So if we get just a stagnant economy and then a possible reacceleration with much less inflation, those stocks could go much higher. Well, Mad Money tonight, Prologis has pulled back. So this logistics REIT might be the right choice for your portfolio. It's the kind of stock that I'm talking about. I'll give you my take. Then with the market bouncing, there's a lot of chatter about a potential bottom. I'm consulting the technicals to see if a bottom is in or more pain could be ahead to verify my intuitive view. And buy now, pay later has been a tough corner of the market. So what could the future hold for lending tech that sells at a high multiple to sales? I'm digging into space. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.